Every year, millions of diligent savers congratulate themselves on growing their balances, unaware that their bank account is actually a leak in their financial bucket. While the numbers on the screen may be rising, the actual value of that capital is undergoing a mathematically certain decline that most people never see coming. The traditional wisdom of saving for a rainy day has been upended by a global economic landscape where interest rates struggle to keep pace with the cost of living. For anyone holding significant cash in a standard account, the perceived safety of that bank vault is actually a high-speed treadmill moving in the wrong direction. This deep dive uncovers the mechanics of this safe money trap, revealing how inflation, taxes, and opportunity costs turn a 0.01% interest rate into a guaranteed net loss. Understanding these hidden forces is the first step toward moving from a strategy of wealth erosion to one of true capital preservation. Inflation is often described as a silent thief, but in reality, it is a predictable economic force that acts as an invisible tax on every dollar stored in a traditional savings account. When the consumer price index rises, the quantity of goods and services a single dollar can purchase inevitably shrinks, meaning a static bank balance buys less every single month. Consider a scenario where an account holds $10,000 earning a standard 0.01% interest. If the annual inflation rate sits at 3%, that account loses nearly $300 in real purchasing power over 12 months. The numbers in the app remain the same, but the holder's ability to pay for rent, groceries, or fuel has effectively been slashed. Historical data from the Bureau of Labor Statistics shows that the purchasing power of the dollar has declined by over 85% since 1970. A basket of goods that cost $100 5 decades ago now requires over $700 today, proving that cash is a deteriorating asset when held over long time horizons. This erosion is not a temporary glitch, but a structural feature of modern monetary policy, where central banks target a 2% annual inflation rate as a sign of a healthy economy. For the individual saver, this means the safest place to keep money is also the place where its value is most likely to be systematically dismantled. But here's where it gets interesting. In response to rising costs, many financial institutions have begun marketing high-yield savings accounts with interest rates that appear attractive on the surface. However, a closer look at the data tells a different story, as these rates are often trailing indicators that fail to account for the impact of federal and state income taxes. If a saver is in a 24% federal tax bracket and earns 4% interest on their capital, their take-home return is actually closer to 3%. When that 3% net return is compared against a 4 or 5% inflation rate, the high-yield account is still generating a negative real return for the owner. Furthermore, banks utilize these customer deposits to generate significant profits for themselves by lending the money back out at much higher rates. While a saver might receive 4%, the bank may be charging 18 to 25% on credit card balances or 7% on mortgages using that same capital. This massive spread between what the bank pays the saver and what the bank earns from the borrower represents a transfer of wealth from the passive individual to the financial institution. The saver takes on the inflation risk while the bank captures the interest rate spread, making the savings account a highly profitable product for the bank, but a stagnant one for the customer. The reality is that these accounts are designed for liquidity, not for wealth creation, yet many people use them as their primary investment vehicle. The data tells a different story about the long-term consequences of this choice. Beyond inflation and taxes, the most significant hidden expense of a savings account is opportunity cost, the profit lost by not choosing a more productive alternative. When money sits in a low-interest account, it misses out on the power of compounding growth that has historically been available in other asset classes. For example, over a 30-year career, the difference between a $50,000 balance in a 1% savings account versus a 7% market benchmark is staggering. In the savings account, that money grows to roughly $67,000, while the alternative benchmark would have grown to over $380,000. That $300,000 gap is the safety tax people pay for the emotional comfort of seeing a stable number in their bank app every morning. This drag on a person's net worth can mean the difference between retiring 5 years early or being forced to work an extra decade to cover rising costs. While volatility in other markets can be intimidating, the long-term history of the global economy suggests that productive assets generally outpace cash over 10 to 20-year periods. By avoiding all short-term fluctuations, savers often lock themselves into a long-term certainty of underperformance. The danger isn't just that the money isn't growing, It's that the gap between a saver's wealth and the cost of the lifestyle they desire is widening every year. This leads to a psychological phenomenon that keeps people trapped in this cycle. Human psychology is naturally hardwired for loss aversion, a survival instinct that makes the pain of losing $100 feel twice as intense as the joy of gaining $100. This evolutionary trait makes a savings account look attractive because the balance never goes down in nominal terms, providing a false sense of absolute security. Behavioral finance studies show that people often hoard cash during times of economic uncertainty, even when the data suggests that cash is the asset most vulnerable to devaluation during those periods. This flight to safety is often a flight to a guaranteed loss, as savers prioritize the comfort of the present over the solvency of the future. This cash trap is particularly prevalent among those who lived through market downturns and now view any fluctuation as a threat to their survival. They fail to distinguish between volatility, which is the temporary movement of price, and permanent loss of capital, which is what happens when inflation eats a currency's value. A healthy financial plan requires an emergency fund for immediate liquidity, but keeping hundreds of thousands of dollars in a basic account beyond that threshold is statistically one of the most expensive decisions a person can make. Reframing cash as a short-term tool, rather than a long-term storage, is essential for maintaining wealth. By understanding that the safe option is actually a slow-motion risk, individuals can begin to look at their capital through the lens of purchasing power rather than just numerical balances. This shift in perspective changes the definition of what it truly means to be financially secure. The most important takeaway is that while a savings account offers peace of mind today, it systematically erodes the ability to buy a future tomorrow through the combined forces of inflation and taxes. If this breakdown of the hidden costs of cash changed the way you view your bank balance, the next video explores how institutional investors hedge against currency devaluation.